just like anybody in here that was actually holding shares, and they don't teach us anywhere and nobody ever talks about it, but I'll tell you now because you're in a master class. If you hold shares, I don't care what market it's in, you should also be hedging that with puts. Do you know why? Because if your share price goes down, you lose its value right away, right? It's intrinsic value. But if you use some of your insurance money, let's say you spent $10,000 on shares, right? Let's just use that as an example. You should probably spend 2,000, which is 20% on your insurance. Don't you put insurance on your home?
Yep.
Yeah.
Wouldn't you want insurance on this asset?
Yep.
That's brilliant.
There you go. So now I've protected some of my shares, some because you don't get full protection, but I protect some. And you do that by buying these leaps. Okay. So even though you're like, well, I don't care, I'm just going to hold it for 80 years. Well, that's fine. Well, what happens in this next year if it's this market? Isn't it worth giving up 20% or 10% or 5% or whatever value you think it's worth? You get insurance, right? That is your insurance. That, and no one will ever teach you that, but me being the 30 years in this crap will tell you, you should hedge your shares. I don't care what you're doing. I don't care what the market looks like. You get to protect some of it. If you're like, well, I can't afford $10,000 in 2000. Well, then you don't. Then you get 8,000 in shares and $1,000 insurance policy, right? Shares, puts. Does everybody see how that works? So start looking at your shares as your home or a car, and you need insurance. That's called hedging. And you need to hedge everything you do if it has any type of value, right? So when Kelly asked me today, what should I do with those? The hedge is to sell them to make the money or to move them to a later date because they're going to run out of time, right? So we either collect the money now or we hedge them by buying more time. Okay? That's the hedge.
My first thought about this is that, you buy the share, and then at the same time, when you have a put, and if the shares go up, but then the puts insurance will go down. So
that's correct.
It takes money out of your shares that are going up if the market goes up.
It doesn't take money from your shares. It just takes the premium away that you have for over 2+ years, right?
Yeah.
It doesn't take it away because how does the market work?
Up and down.
Right?
Okay, I get it.
At any point, you can do whatever you want with those puts, right? It goes down, you were protected. It comes back up, right? You could sell them or do whatever you want. Vice versa, over.